The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everybody. My name is Megan Cox, and I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar. It's go time for commercial banking. Are you ready? As the industry's leading provider of data analytics and technologies, we are here to help you better attract, retain, and grow more profitable customer relationships for your financial institution. If you have any questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording and the deck to you via email post-webinar. Okay, I'm going to pass it to Margarita to begin.
Thank you, Megan. Let's get started. So first, thank you all for joining. This quote, in my mind, sums up why we're focusing today on driving strategic growth in commercial banking. If you think about the last few years, the challenges that we've had really are still with us and are forcing banks to fundamentally think differently about how and where they're going to find growth. So we're excited to focus on that with you today. For those I haven't yet met, I run our commercial banking line of business. I joined Curinos in mid-2024, coming from a top 25 bank where I ran the West Region P&L for everything related to commercial deposits and treasury management. My team covered 6 states and 2 specialty businesses. And leveraging Curinos data was something that I did all the time in collaboration with my pricing team. So we were able to materially outperform industry benchmarks through the rate up cycle. And that was a key part of why I ended up joining Curinos. I'm joined by Peter Serene, Managing Director and Head of Markets Advisory, and Bob Warnock, Managing Director. All right, Megan already gave a quick shout out of who we are. Many of you know us well. As Megan said, we're the leading provider of industry benchmark data and analytics to commercial banks. Our clients leverage our tools and expertise to focus on improving how their businesses perform. We're going to discuss a lot more of that in detail in the following slides. All right, before we dig into growth strategy, we do want to talk a little bit about just the industry context. No 2 banks on this call are the same. We have different sizes, histories, growth strategies, but we're all united by the influence of Fed rates and needing a healthy foundation of deposit balances to grow our business. So we're going to start with a quick view of what you all anticipate for 2025 and how we're, looking at the industry faring in terms of managing deposits through this new rate cycle. So understanding what we're expecting and where we've come from gives us a view into the context for growth in 2025. I'll turn this over to Peter after we do some quick live polls. So, 2 quick questions. Megan, if you have those open.
Been ready?
All right, so this is all about what do we believe will be the average growth across the industry. Some interesting and mostly optimistic numbers coming through. All right, I think we're pretty stable. Megan, do you want to share the results?
Yep, they're shared.
All right. So delighted to see that folks are anticipating growth across the industry, and a third of you having some fairly bullish expectations of up more than 3%, but less than 7%. So only a few pessimists out there expecting that we're going to have less than a 3% or a decline, modest decline by no more than 3%. Peter, any observations on this? Are you surprised to see this, or was this sort of what you are forecasting as well?
Well, these are broadly in line with what we're hearing in the market. We'll touch on this in a little bit more detail once we get into some of the backward-looking data. But it's worth noting that these results are a material improvement from what we've seen overall in the last year. So this would represent a change in the market, not the status quo. We've been flat overall. Obviously, banks have done better and worse around that overall flat, which probably leads us into the next question pretty well.
Great, Megan, if you can tee up the next poll. So, what is your bank's 2025 commercial deposit growth goal? I like to see the aggressive growth numbers coming through. The interesting effect always is everyone is expecting to outgrow what the market is pacing at. So that's always the challenge, right? We are expected to grow more than the rest of the industry is targeting. And that's how we get into this challenge of strategically growing in a way that's different than what everyone else is doing. Peter, is this in line with what you would generally expect?
This is what we've seen when we've asked that question, and you nailed it. This points to competition. We're all fighting for a larger than fair share of the total outlook for market growth.
All right, so I'm going to turn it over to Peter, and we will talk about what have we actually been seeing.
Sure. So very briefly to kind of level set the context on what's happened in this in the falling rate environment so far. Really strong aggressive performance from commercial businesses in bringing down pricing. You see similar results from wealth, similar results from direct banks. Much slower going in small business and consumer, where you have much more of the portfolio priced at sort of near zero rates, where there's nowhere to go down, more non-interest bearing, et cetera. The interesting thing when you look at this page, though, from a forward-looking standpoint, is you want to look not just at the total portfolio, the betas, but the total portfolio rates, and then the rate at which money is changing hands, and that has real implications for where banks and CFOs and treasurers look to ask the business to help manage bringing interest expense down, but also where they look to ask the business to help bring in new deposits. And when you look at it through that lens, particularly from an acquisition standpoint, even though commercial deposits kind of get this reputation of being expensive, and you can see that relative to certainly relative to small business and consumer, where you have all these free deposits, sure, they are a little bit more expensive. But when you look at what it takes to bring in, just in nominal terms, new money, they're very competitive with other segments. In fact, less expensive than overall than in wealth. And that's before you layer in sort of the total marginal cost and cannibalization expense. So, as we think about a market where banks are expected to grow in 2025. That's built into the stock prices. That's built into the optimism in the market. We're going to need some raw material to do that. And looking at this page, commercial appears to be a very, very important place to go get that growth. Getting that in a cost-effective way and a high-quality way, driven by primary relationships, will differentiate those that perform best versus the rest, and that's what we'll get into a little bit more. Very briefly on that overall environment, if we go to the next page, what you see here, I mentioned when we did the poll, we think we're going to be up 0 to 3 or 3 to 7% this year. That is not where the industry has been overall. We've had periods of ups and downs over the last couple of years, but this has really been a sort of flat overall market, characterized by some share taking by the top half and the bottom half that have run sort of this consistent 15 to 25 points in spread in overall performance. Underlying our forecast model, the purpose of this isn't to go sort of deep on forecasts, but if you expect that pie to grow, you really need a combination of pretty strong pretty strong economic growth, pretty strong pricing to pull those balances onto bank balance sheets rather than into government securities, and you also have the impact of quantitative tightening, which is still running. The Fed in the most recent minutes began to touch on when that may wind down, but that's a governor on total growth, as it has been for the last couple of years. So we can certainly hope that that the market's going to get a little bit easier, but I think we have to plan for a market that's very competitive, where we're going to be having to take share to grow. Bob, Margarita, from sort of a macro perspective, anything you'd add there before we jump into so how do we do it?
I'll just add one aspect. So I've come out of meetings all morning with two different treasury teams, one a super regional, one a local regional to the market I'm in right now. Both absolutely surprised to the degree that the portfolio and acquisition rates have now stacked up, especially within commercial and to a lesser degree wealth. But also, shockingly, they were asking questions around what does this mean for the consumer and business banking funding pressures for our growth goals within commercial. We need to figure out how to balance incremental balance growth of what is perceived as higher quality relative to the incremental cost that we might have to take on in commercial or in consumer and business banking relative to commercial. So I know this is very much a frontline geared call and strategy geared call, but please note that your treasurers and your finance team are starting to take note of the need to get very surgical at relationship pricing to avoid the 8 to 10% marginal cost of funds required in consumer business banking.
And that's where then we get into how are we in commercial going to drive intentional growth. So let's focus on the priority areas. Here's really what we're hearing from our clients. And the work that we are doing with our clients to address the numbers that we just saw, and that disconnect between a growth aspiration, obviously not just in deposits, but the deposits are the fuel for our balance sheet and being able to grow those lending relationships. So what are those four things? First, focusing on mix and total relationship value. So when we think about C&I lending being a key focus and the pullback from commercial real estate, this is a critical space for driving total relationship value. Differentiating to win. It is incredibly competitive out there. Banks are making investments and moves that are giving them a way to stand out, but they're increasingly getting encroached upon by other competitors. Continued pricing discipline, regardless of the rate environment. So a lot of the numbers that you've seen so far, we'll share some more numbers, all come out of our analyzer solutions, and it's how we keep an eye on how the industry is doing. But how you are doing is a critical part of understanding, are you exercising the right level of discipline? And then lastly, of course, all of this comes together with an effective sales force that is aligned to those top strategies, that are aligned to the type of mix of relationships that the organization wants them to bring in. All right, Peter, a quick hit on some of what we're seeing.
Yeah, so that's all great, but there's some challenges here that we're having to respond to in the industry, and they're not really new ones in terms of where we are. The first is playbook for a long time has been lead with the credit, pull through the primary relationship, and that's our leverage in the relationship. Well, in the core middle market space, private credit is taken up from sort of 7% share, almost a rounding error 15 years ago, up to north of 20% share in the market today. Or the complete data runs through 23. We're still compiling the 24 numbers, but we would expect that trend to continue to run up. So that does require a different playbook for what is now a meaningful segment of the market. At the same time, how we get there looks a little bit different. So We've talked about the remixing that's occurred between non-interest bearing and interest bearing deposits through the rising rate cycle. You can see we've gone from roughly 50-50 to 70-30. That is an enormous amount of money that we need to recover from an overall line of business profitability standpoint. When we consider that even if once you add back in some of the fees that were maybe dropping to the bottom line versus offsetting with ECR, that's a 2 to 3% difference in terms of the economics from the deposit side of those relationships. That trend has slowed down, right? For a while we were seeing 1%, 1.5% every month remixing. That's flattened out, particularly for the larger balance clients, but it has not reversed, and so that's something that, from a total relationship standpoint, we need to recover. So how do we start to think about doing that? This is, Margarita and Bob, I think, both used the term surgical in their remarks earlier. Here it really is about understanding where we have a right to win, where we have product capabilities, expertise that'll differentiate our ability to win, and understanding the underlying nature of what winning looks like in these segments. So that can mean being really focused in terms of which part of the market we're playing in from a chalk line perspective. That can mean the verticalization concept has been around for a long time. I think what it means to win from a vertical standpoint has evolved a little bit. So now it's there's a component to sort of is expertise managing the risk associated with that, so you can maybe be a little bit more competitive with private credit and getting to yes in the buy box. But then also, as cash conversion cycle has become much more important in dollar terms to our clients, the ability to have a really advisory perspective through our treasury management within those segments is emerging as a major differentiator. And then, finally, just this is kind of the basics, but really understanding once we pick our spots from a segment standpoint, from a vertical standpoint, how we drive those C&I relationships through to primacy.
And
Margarita, go ahead, Bob.
It does not mean that we're saying all CRE is bad. There are still decent verticals within CRE that can contribute in a positive light to your P&L. What we are advocating for, though, is understanding if you are a CRE-focused bank and you have a long roadmap into C&I, how can we make the best of a current difficult situation given the leverage profile of those clients?
Yeah, and that is.
Oh, go ahead, Peter.
We're all piling on this point. The other thing is just back to that sort of what's going on in from a broad perspective. We're coming out of an environment where the market, even with the kind of surge outflows and remixing and flat growth for a couple of years, has been pretty flush with liquidity. If you look under the hood a little bit, if you look at some of the mid-sized regional banks, they're back to more like normal levels as a group in terms of loan to deposit ratios. If you look at the reverse repo facility, the Fed reverse repo facility, which is a shock absorber for excess liquidity, that's down 95% from its peak. We're almost back at normal. So, when you think about these trade-offs around which side of the balance sheet am I growing, of course you have to do both. But for a lot of banks, we think we're entering a period where the challenge being how do I deploy the money to the challenge being how do I raise the money is coming back into a more normal balance for the industry.
The last comment I would say, and it's probably a segue to your next page, is that sense of as we look at how banks are adjusting their segmentation strategy, you just have to be careful that you're not just rearranging the deck chairs, but you're truly solving a go-to-market or servicing model challenge, or you're finding that this is a new way to focus your sales teams, and it's around an area that you believe you have strength, and it represents an additional investment in those strength areas versus sort of playing with those lines, hoping for a different outcome. It has to be backed by how are you going to materially change the way you go to market. Okay. Peter, why are these C&I relationships so valuable?
Look, so this is, this is the payoff, right? At the end of the day, it's really around payment complexity and operating leverage. So, we'll take those in the reverse order from an operating leverage standpoint. These C&I businesses, they have more payment complexity, and so they have more frictional cash. Obviously, there's huge differences in net leverage within individual companies and segments within the kind of broad C&I landscape, but relative to whether it's real estate or ABL structures and so forth, the core kind of bilateral C&I is where you tend to get the operating deposits. How do you do that? You need the right relationships in the door. You need to win the true operating activity, and you need to use pricing effectively to do that. What we often see is kind of the peanut butter approach on pricing, where we're not as aggressive as we could be to win, but then over time we're also not recapturing the economics of the relationships. The next piece is incentives. You get what you pay for, and so there's really a lot of things you can do from a team operating standpoint, but if you're not offering hard incentives on operating relationships, driving that connectivity between the banker and treasury management, you're unlikely to get the full results. And then the last is products. This is an area where there's been quite a bit of innovation in recent years. You're seeing new payments rails, faster payments rails. The other point that I would bring here is some of it's product, some of it's expertise and strategic partnership. But we are back in an environment where all of the disciplines around treasury management, based on the value of the time value of money, are so much more important than they were in the zero rate environment. So the products to execute those, whether those be pricing, faster payments, et cetera, as well as a comprehensive suite of liquidity products, is critical to sort of get that last leg of opportunity. Margarita, do you want to talk a little about the fee side?
Sure, and that is exactly the hand in glove of winning those core operating balances, but then also winning the treasury management fees that come with it. So when we think of, on the left-hand side, a credit leverage ratio relative to what is your annual gross TM fees relative to your C&I loans outstanding, the ability to move up in your saturation of the wallet and get those more complex relationships begins to drive more bottom line revenue and financial performance for the business. Again, how do you do that? Very similar. From a fee side, it is winning those right relationships. So you're winning the relationships that have volume and have activity. And then on the bottom, optimizing that cross sell. For those longstanding relationships that you have, do they see you as their core operating bank, as their core provider of technology solutions? In a lot of cases, it's not just getting those right relationships, but reframing the value your existing clients believe they should be getting from you. And then in the middle there, obviously delivering valued products is key. Peter already talked about that a little bit. And then how do you price them correctly? You want to price them aggressively so that you're getting paid for products that have varying levels of cost to deliver, and not going too high that then they're tempted to shop the relationship. That's that key of balancing the relationship value, but then the profitability to your bank.
I'll just add one aspect since it was asked in email. Everything that we showed you on the previous two slides on the far right of the screen for the top quartile, those are definitely geared more towards best-in-class verticals, as well as largest super regionals and nationals. Most of the regional banks are definitely in that bottom quartile. Median is kind of where we are clustered, obviously due to concentrations and where we started off as a starting point. And then lastly, we will reiterate, this is true C&I lending. There is no owner-occupied CRE in these numbers. There's no business banking in these numbers either that is inflating either of the measures.
is a helpful construct to assess your business, and it's a lot less about where am I, well, it's both where am I now, an honest look, but then what should I aspire to? Doesn't mean you need to be in top quartile, but how you move rightward is the key. And to an extent, so, mentioned this already, differentiation is important, especially in the payment space where that has moved rapidly over the last few years, especially as lending was a bit more muted and there was a real push for those operating deposits, the operating relationships, those fee-rich businesses. And a lot of that comes through how are you differentiating your payments capabilities. The trick here is that the competition is coming on many fronts. So banks themselves are, of course, investing in their platforms, their own digital platforms and solutions. And then you have platform players where we're even seeing that encroachment from accounting systems and ERP systems that themselves want to be the primary platform that large corporates are using to execute their business, to a point where maybe they don't even need to know who's the bank in the background. And then the third category, your processors, fintechs, they're always going to be putting pressure, not just on new capabilities, but resetting the bar with clients, with your clients, around what does best-in-class payments and frictionless payments look like for them. So I think it's, in my mind, it's less about how do I compete against those deeper pockets. It's more about deciding what are the bets that you're going to place on how you differentiate and really win in your target markets, your target verticals. There's not a quick and easy answer across the board. This becomes very specific to your bank's starting point, and making sure that you're taking a hard look at where do you believe you can win and what are the key investments you need to make in capabilities to get you there.
I think that's a key point, Margarita. Don't underestimate the value of a simple product change either. The products have gotten stale for a majority of institutions, so simple tweaks to the design tailored towards the liquidity optimization can be equally, if not more, needle moving to a bank that is starting further to the left against any of these differentiation strategies.
Great point. Okay, so we have talked about mix and we've talked about how to differentiate. Those are all about growth. As we all know, the other part of this is how do we ensure that we're disciplined in managing the existing portfolio, because those can drive our growth levers as well. So we can actively see with our clients, because we get all of their data, how disciplined they've been with their pricing through the prior rate cycle, the rising rate cycle. And really what we're seeing is that there's a really different arrival at the inflection point of falling rates. So that's what this page is taking a look at. So this is an indication of discipline and effectiveness through the rising rate environment. The y-axis is the weighted MMDA savings rate for that portfolio. And then the x-axis is how much did those balances grow. As we look at these quadrants, the yellow quadrant is the one that everyone wants to be in. Right? Did you arrive at the falling rate cycle with a balanced growth, but you didn't have to pay up to the highest levels? The purple quadrant is the most challenging one. Banks who experienced low growth, but still had to pay up in order to get those retain balances that they were able to retain and acquire replacement balances. That's a very tough part to be in. And what we see there is it's all about to what extent did banks already move into that primacy posture that valued the core C&I commercial relationships, that knew how to position to win the operating relationship to get those healthy, low-cost, stable deposits alongside the fee-rich TM business. So this is, again, for those clients that we have, if we haven't yet plotted this with you, reach out to us, reach out to me. Happy to walk you through where you stand. If those of you aren't yet clients and you don't know where you stand, it's worth getting figured out.
Before we jump to the next slide, I think this is a key point because I noticed that a number of people have come off of the quote unquote not aware. So people are picking up on, whoa, where do we stand right now? And I'll go back to the Treasury conversations I had this morning. People were very interested in how we can be more surgical based on our starting point. This is the largest needle moving item from an annuity standpoint on the bank's P&L today. 1 basis point per $1 billion is $100,000 immediate revenue impact, and that is an annuitized impact. So while you're looking at your strategies to optimize relative to where you are in terms of starting, please be aware that it really moves the needles 1, 2, 3, 4, 5 basis points. And we see 40, 60, 70 basis point ranges across products, across NAICS, across geographies today to take advantage of.
Bob just perfectly teed up my next page, which is, you know, those banks who use data with discipline through cycles outperform. So when we look at this page, the black fixed line and the dotted line are the all-in portfolio rate across banks, and then the 3-month rolling acquisition rate. The blue line are our top quartile performing banks who we know, we have spent a lot of time with them. They're actively using the insights about the industry to temper the activities in the field, to be informed by what rate is really being offered out there, and don't go to the top. So you can see with the blue line, the lower or the delay in beginning to elevate the acquisition rates and the discipline around repricing their existing portfolio led to a material gap in how they performed in terms of the weighted interest rate, delivering millions in terms of annual interest expense saved. So to Bob's point, every basis point you can shave from your commercial deposit costs translates to real revenue. All right, I will keep going. This is just a shout out to the banks who have been leveraging the commercial analyzer insights. And what have they been doing to outperform the market? I'll focus on the bottom here. It's all about that transparency, having really rigorous governance. Do you align the incentives across your organization effectively? And how are you then able to capture profitable growth? So happy to walk anyone through, you know, what does this look like? But it does start with, are you becoming a data-driven organization that can drive better outcomes? Anything
or
that
are you being
add?
held hostage to anecdotal front lines?
Yeah, that does happen, yes. A belief that the pulse on the competitive market is gotten from one client interaction. All right, so we talked about disciplined pricing. That only works if you have a sales force that is effective in how they you know, face off with your clients. So having an effective sales team in the field, here are some of the key best-in-class attributes that we see. So is there a go-to-market approach that is focused on client value? We're going to press in on that a little bit in a moment here. Aligned incentives. So as you are looking for a new mix of business to come in, how is your field being motivated and incented? And then are they effective in collaborating with their key expert partners in treasury management? And do they have aligned incentives? So it's not enough to say I've got my bankers incented in the right way, but do they feel a sense of kinship that my ability to win those operating balances, win those fee-rich relationships means that I understand how to win with my partners. And then lastly, similar to what we just talked about, having those really data-driven operating routines that hold people accountable, but also give them the tools and the insights so that they feel empowered to shape their business. So when we think about Salesforce effectiveness, just hitting this at a high level, Salesforce effectiveness, historically, what we've seen is banks go to market where the client is at the center, and then that RM is that primary point of contact who is nurturing that relationship with the client, but unfortunately, ultimately can end up almost functioning as a gatekeeper, where your experts are sort of brought in episodically and are kept at arm's length. And what that really does is it limits the ability to shift who you're addressing in the market as fast as many banks want to. So we are increasingly seeing that the more successful banks are going to market more with the picture on the right, which says you're surrounding the client with expertise that helps align the conversation to where the client is focused. Are they trying to grow their business faster? In which case, they probably are talking with you because they need access to capital. But maybe they're really just trying to run their business better, and they've either outgrown a smaller bank or they're not getting the help that they need from a larger bank. And it's that operating relationship that they're looking for a better fit. And that's where you really need to have that treasury management officer in the room with the RM to get quickly to that value unlock. And then, of course, maximizing enterprise value. That's where you think about things like, are we bringing our capital markets expertise where we have it? Do we have the right, C-suite wealth advisors at the ready to engage with these clients around their various needs? At the end of the day, it does come down to accountability and execution. So the growth strategies that we are, advocating for have to then translate into, as I already said, the incentives. But then do I have the processes and tools? Do I have the governance routines and the reporting routines where I can hold people accountable to making the shifts I'm asking them to make? But also importantly, am I ready to swoop in if a high-performing banker who I'm asking to do different things is a little bit struggling with that shift? So making sure you understand what are those weak signals that say, okay, I have people moving in the right direction, but some people are being left behind and I want to help them. So that's where you get into just really looking at the activities, prospecting, backbook management, and that's where getting that outside in view on a regular basis really helps to see, are we driving the kind of shifts that we want? Are we acquiring relationships and balances at a price point that we want? And then is that translating into mix shifts? And is the rest of the industry doing the same thing? Probably. So are they doing it better than we are? Or are we actually doing it pretty well? We're here to help you get that outside in view. Anything else that Bob and Peter, you'd add?
Picking up on Bob raised a good point back when we were looking at the CLR about what does this mean for different sizes of banks, different places on their sort of evolution growth journey. This is another one, this and that and the prior page, where we see it's not universal, but we do see some real distinct differences between, call it the emerging smaller regionals and the larger banks. It's a very common evolutionary point, moving from viewing treasury management through more of a product and operational lens to more of a strategic client partner lens. So for those that are in that, sort of in that tier, these points are, I think, ones that are really worth reflecting on where your organization is. Certainly, there are those who are, well ahead of their peers and do this as well as anybody. But there are a lot who still kind of bucket it almost more in an operational onboarding lens and a product lens as opposed to a real value driver for the client.
Great point. Now let's talk about generally pulling back a step. How do you think about accelerating your strategy? Bob, I think you were going to talk a little bit about what are some of the things that we've actively been doing with our clients and making sure that people know we're here to help.
Yeah, I'm not going to spend too much time on this slide. I think we've covered a lot of the more detailed aspects in the previous slides, but I'll summarize it as 4 big camps. One is, what is our strategic growth plan in terms of acquisition and isolation? Are we growing the right segments within our markets? What is our right to win? And how does this impact overall bank enterprise value from a balance sheet aspect? The second big camp is, we have a good strategy, or we know that we have opportunity, but we are not batting at our fair share. What does that deepening playbook look like? We may be underutilizing TM, we may be over-indexed into CRE relative to the CNI opportunity. We may not even be getting our fair share of wallet with our owner-occupied CRE. How can we more effectively drive customer level deepening of the wallet across all 3 stool legs, if you will: lending, TM, payments, and deposits? And then finally, or I guess third, the optimization of price. This is the surgical aspect. We are either hitting on all cylinders or we are not, but there are still easy opportunity for us to fine-tune customer pricing in a way that drives value for us and for the end client. This may be through an exchange of revenue for TM relative to interest expense, or vice versa. The point is that we are now in a world where the client values cash optimization more than it values extension of credit alone. And incorporating that into the pricing discussion becomes paramount to driving incremental value. And then finally, what does the sales effectiveness strategy look like? Everybody talks a big game in terms of we have the opportunity and the best bankers. The problem is the majority of bankers today have not lived through a cash optimization cycle. Multiple CFOs have come to this realization, ensuring that your team can hit the ground running and in a way that drives incremental value without the expense of just over leveraging the balance sheet without commensurate fee income or liquidity, becomes the target for a majority of enterprise level goals from the C-suite. Those are the big 4 realms. I know we've discussed multiple aspects of them in previous slides. If anyone has any follow-up questions, please don't hesitate to reach out to the 3 of us on more details. But that is how I would say the majority of our clients have asked us to help accelerate their strategy in 23, 24, and early innings of 25.
Great recap, Bob. Thank you. All right, we are on our last poll, and then happy to open it up to questions. So if we can hear, as you think about these 4 areas, what is your top strategic priority? Wow, some really good numbers coming in. They're still coming in, so we'll give it another minute.
Well, at least the presentation was entertaining, because now we're over 70% voted. In the earlier polls, we were just at 50. So glad that everybody's enjoying the content.
They don't want to have to go on record of what they believe their deposit growth should be. All right, really interesting. So Peter or Bob, do one of you want to comment? I think these are really interesting results.
I actually think this is indicative of exactly the 4-quadrant page that we highlighted for surgical pricing abilities. That page goes obviously far beyond just pricing and discusses what our starting point was. How did we get to where we are? How do we course correct it? Pricing alone won't solve it. We need to focus on each of these aspects. And I think it's interesting that, you know, I haven't done the hard math, but almost like for like in each quadrant, I assume that we could develop a similar percentage base for starting points of where those banks are based on these responses. I will say that this emphasis on Salesforce effectiveness really picked up in the second half of 24 for the largest institutions and a few of the smaller institutions, and it has continued through 2025. I am surprised to see that continued pricing discipline agnostic to rates is not a little higher, given the conversations that I've had year to date with some of the treasury folks who may be, you know, influencing or incentivizing some of the discussions that you're having on the front line. I wouldn't be surprised if if that drum beats louder as you get into, you know, the first quarter of the year without more, you know, directional certainty from the Fed. And then lastly, you know, not surprised that the differentiating to win is on the lower side here. It is something that does take a little bit of scale and investment as well as time. But again, I would encourage all of you, do not underestimate the value of simple tweaks to the deposit and liquidity suites to ensure that you're creating a fair value exchange.
And I think a lot of it has to do with, as you're figuring out that growth strategy, number two kind of comes after that, right? As you say, where do I believe I can win better and drive more total relationship value? Immediately after that comes a gap analysis of, okay, this is where I want to be playing better in the market and I want to differentiate here. Do I think I can? So I think those can end up going fairly hand in hand, but really interesting results. I will say we can certainly open it up to questions, but I believe we might be coming up on time here. So let me just flip to the next page because this is the words of encouragement. Do what you can with what you have, where you are. And I think that is really important to just take that honest look of where you stand. We're here to help you do that. And it's not a gut check. There's numbers behind it, right? Where you actually stand is a numbers game, and how you shift your business is a numbers game. So we're here to help you do that. Did any questions come in, Megan? Because I think we've been going for a bit here.
I think we're good.
All right. Well, thank you everyone for joining us on this session. If there's anything that you need from us, we are here to help. We'll be sharing, I think, Megan, the recording, I believe, and that if anyone needs the materials themselves, please feel free to reach out to one of us. All right. Thank you.
Thank you.